In today's video, I'm gonna take the mystery out of stock market investing so that you can put those hard-earned dollars to work and be on your way to incredible wealth coming up. Welcome to the Journey of Finance, where personal finance is made simple. My name is Cedric, and here on this channel, we talk about how you can manage your money and invest your way to retirement. I upload new videos every week on this channel to help you level up on your finances. So, if you're down to go on this journey, then do me a big favor and subscribe to this channel and click on that notification bell so you're notified of every new video, and smash that like button down below. It lets me know that you're enjoying the content and lets YouTube know to push this content in front of more people. Stock market investing can sound extremely intimidating. We oftentimes hear about the looming inflation, the impending stock market crash, and people losing lots of money in the stock market. And yes, those things can be true, but it doesn't have to be scary or complex. In fact, I truly believe that for most investors, like you and me, would benefit from having a simple approach to stock market investing that has stood the test of time and has brought great returns for those who have stuck to the basics. So no secret get-rich-quick schemes here in this video. We're simply gonna break down how to get started with investing in the stock market made simple. So in an effort to keep things organized, I'm going to cover the following topics in this video. You can also refer to the timestamps below if you want to reference a certain topic. So without further ado, let's get into it. What is investing? Investing in its simplest form means that you put your money into an asset for a return on your investment. In the world of the stock market, that might mean that you purchase a share or percentage of a company at a certain price in hopes that that price will go up. Or in the world of real estate, it might mean that you purchase a property with the hope that it will go up in value. When you invest, you carry on a degree of risk in order to reap a reward. Why you should be investing. In order to grow wealth and to diversify your assets, there are a few things better and more practical than investing your hard-earned dollars into the stock market. Among the many reasons why you should invest, here are a few for starters. Inflation. Inflation occurs when the prices in the economy increases over time, leading to the decrease in the purchasing power of any currency. A perfect example of this is when I started to drive in high school and got my first car. Gas prices at the time were about $1.35 a gallon, give or take. Where are the gas prices now? That's inflation. My same $20 bill can't purchase as much gas now as it could 20 years ago. That's a decrease in purchasing power. Because the value of the dollar stays the same, one of the best ways to combat inflation is to invest your dollars to get a return that outpaces inflation. Since inflation has averaged a little over 2% a year since the year 2000, you're better off putting your money into the stock market, which has averaged over a 10% return over the last 50 years. Grow your money. Investing in the market gives you the opportunity to grow your money outside of your interest-bearing savings account, which at today's rates doesn't beat inflation. If you consistently invest your money into the stock market, over time, your investments would grow, not only due to the value of your investments growing over time, but also due to the power of compound growth, which is where your money grows faster because it grows based off of the accumulated growth of your investment, creating a snowball effect. Save for retirement. Investing in the stock market is a very effective strategy to build up your retirement savings, also known as your nest egg. It allows you to accumulate throughout your working years until you plan to retire. From then, you can live off of your retirement investments by implementing a withdrawal strategy that will keep you funded throughout your retirement. Save on paying taxes. There are different types of investment vehicles out there. They allow you to invest pre-tax dollars into retirement, which are tax deductible, meaning it lowers your taxable income, saving you more money on taxes now. The 401k and traditional IRAs are popular investing vehicles that allow you to do this. Misconceptions about investing. Before we get into stock market investment options and how to get started, let's briefly go over some of the common misconceptions about investing. It's too risky. You may oftentimes hear from people that investing in the market can be risky. What if the stock market crashes? What if you lose all your money? What if you get scammed? There is a spectrum of risk when it comes to investing in the market, but there are many ways to hedge those risks through proper research, a diverse strategy, and a long-term approach. If you look at historical data, the stock market has always gone up despite recessions, setbacks, and crashes. You need a lot of money to invest. Nope, you can start for as little as $1. These days, you can get started for a very low amount, get your feet wet, and eventually dive in deep. It's expensive to invest. These days, you can invest your money without incurring costly fees or paying a broker. Low-cost index funds and ETFs are popular options for keeping fees very low and reasonable. You need to be a stock market expert. On the contrary, you don't need to be an expert at the stock market at all to reap the rewards and benefits of investing. At the very least, as long as you understand the fundamentals of how the stock market works, how to invest, and understand which investment vehicles you choose to invest in, then you're gonna be fine. So with that said, let's get into some of the different investment options out there. Stocks. When a company goes public, it simply means that they are issuing shares of ownership of the company in order to raise money to run the business or fund the productions of new products or to expand their business. These shares of ownership are called stocks. If you purchase one share of stock in any given company, you are purchasing a fractional piece of ownership in the company. Now, before you go printing business cards saying that you are part owner of the company, you have to realize that publicly traded companies may issue thousands or even millions of shares. So your ownership in the company is divided amongst other shareholders of your company. Your degree of ownership in the company is directly tied to the amount of shares that you own. Here's an overview of how it works. Let's say you purchase one share of Apple stock, which at the time of this recording is $144.57 per share. Out of all of the 16.69 billion shares outstanding, you would own one of them. So the more shares you own, the more ownership of the company you have. But for most investors, they are not interested in the operation side of running the business. They simply want to invest their money and make more money. So then how can you make money with stocks? There are two main ways that you can make money with stocks. The first way is through capital appreciation, which is where the value of the stock increases over time. So if you buy one share of Apple at $144 today and you sell that one share of Apple next year at $154, you made $10 in profit. It may not sound like much with one share, but if you owned 100 shares at $144, then you would make a profit of $1,000 on your investment of $14,400. The second way that you can make money is through dividends, which are typically quarterly payments that companies will pay out to their shareholders. The amount that is paid out is based on your percentage of ownership of the company. Not all companies pay out dividends, but for those that do, you can usually opt to receive the dividend payments to your brokerage account or have it reinvested back into the stock. You will notice throughout the day that the stock's price fluctuates. That's because throughout the trading day, stockholders are selling their shares to buyers who want to buy them. That's why the price of the stock is determined by the principle of supply and demand. If there are more buyers or demand, then there are people willing to sell their stock, then the price naturally goes up because buyers are willing to pay a higher price. The reverse is also true in that if there are more investors wanting to sell their stocks than there are buyers, then the price of the stock goes down because there aren't enough people willing to pay that price for the stock. The result of this fluctuation in stock price is called volatility. That's why a lot of people are afraid of losing money because of periods of volatility. The truth is, when it comes to investing in stocks, volatility and fluctuations are a part of the game. But remember, if you plan to hold your positions for a longer period of time, the market over time typically goes up. Now you might be thinking, what if I put most of my money into a stock and it goes down? Now that's definitely a possibility and inherently makes it much riskier. But there are other options out there that allows you to diversify your investing strategy. Mutual funds. If you're looking for a way to invest your money in the stock market, but you don't want to take the risk of investing in one or a few stocks, then you can consider investing in a mutual fund. A mutual fund is an investment vehicle where you put your money in a portfolio that can include stocks, bonds, and other securities. So instead of investing $100 into one stock, you can invest $100 into 100 different stocks, participating in the gains and losses of all those stocks. This is a way to diversify your money by investing in different types of stocks. Generally speaking, mutual funds are actively managed by a fund manager who decides which stocks to put in the portfolio and what percentage of allocation each stock gets. The downside of mutual funds is because you're getting the benefits of a fund manager, you typically have to pay an expense ratio, in other words, a management fee, to invest in the mutual fund, which can eat into your profits, especially over a long period of time. But at the end of the day, if you choose a good fund with a good historical track record, then over time, you can definitely do well with it. Index funds. An alternative to having an actively managed portfolio that carries high fees, such as a mutual fund, you can consider investing in an index fund. These funds are similar to mutual funds in that each fund has a large portfolio of stocks in it, but the difference is that they aren't actively managed and their investment strategy isn't to beat the market gains like an actively managed mutual fund, but to mirror the gains of the stock market through a stock index. A stock market index is simply a way to measure the stock market as a whole or a subset of the stock market. For example, The S&P 500 is an index that includes the top 500 companies in the US stock market and tracks their performance. So an index fund is simply a fund that includes the same companies that a particular index tracks, so your performance is similar or identical to the performance of that particular index. Some of the benefits of investing in an index fund: the fees are cheaper because it's not actively managed, and you get all the benefits of diversification of stocks in one portfolio. This is one of my favorite diversification strategies because it's straightforward, easy to track, and has lower fees. Exchange traded funds, or ETFs. These are similar to mutual funds, except they are not actively managed, which means they have lower fees. ETFs can have a collection of securities that typically tracks an index or a sector or commodity or other assets. They can be bought and sold throughout the day, just like stocks. This is another one of my favorite ways to invest in the market because you get to choose from many different types of low-cost ETFs and easily buy and sell as needed. However, I do prefer to take a longer-term approach with ETFs because many good ETFs provide great returns over the years. How do I get started? So now that you have a solid foundation of investment options that are available to you, how do you actually start investing? One of the easiest ways to get started is to invest in a brokerage account, which is simply an account that you use to be able to deposit your cash into so that you can actually purchase stocks, ETFs, and other investments. One of the most popular ways to open up a brokerage, and a way that I recommend, is to open up an online brokerage account. There are so many to choose from these days, and it's so easy to get started. With some accounts, you can actually get up and running in as little as 10 minutes. I personally use E-Trade as my main brokerage account, which is where I have my index funds and Roth IRA, but there are other brokerages out there like Robinhood, TD Ameritrade, and Webull, which are all available online. Opening an online brokerage account not only gives you the access to purchase stocks, mutual funds, and other investments, but many of them have great resources to help you research different investment options and to track their performances. How much should I invest? How much you should invest will really be determined by your investment goals and your investing timeline. There's no limit to how much you can invest in the investment vehicles we talked about in this video, but if you're completely new to investing and you're a bit nervous about taking the first step, I suggest starting out with investing a small amount that you're comfortable with. For some, this might be $100, and for others, it might be $1,000. Keep in mind that the stock market rewards consistency, longevity, and time in the market, so I wouldn't recommend waiting too long to start investing. But if you can start investing a bit now, then you can quickly get used to the market fluctuations. If you have a lump sum of money that you are ready to deploy in the market and you have a long-term strategy for investing, then you can certainly invest it all and wait it out. But if you're nervous about investing all of your money at once, then you can do what's known as dollar cost averaging your money into the market. This is where instead of putting all of your money in at once, you can divide your money up and consistently invest it over a certain time period, like 6 months or a year. The benefit to this strategy is that you'll have a peace of mind knowing that you didn't put all of your money in at once, and also you are buying investments at different price points. There are pros and cons to both strategies, but ultimately both strategies work, especially if you're consistent and keep your money in the market to ride out the fluctuations. I'll be making more videos on different investment strategies, so stay tuned. Quick tips. So let me wrap things up with some quick and timeless tips as you are navigating your investing journey. Diversify. When it comes to stock market investing, you want to include diversity in your strategy. That's why I like index funds and ETFs so much. When you buy into one index fund, you are inherently buying into all of the companies within that fund. So if some of the company's stock prices go down in any given day, you might have a majority of them that have gone up. Have a long-term mindset. When it comes to investing, your best friend is going to be time in the market. There will be periods or maybe even years when the stock market is down, but if history is any indication, it will eventually come back up and make new highs. So if you want to be serious about investing, I suggest not investing money that you would need in the next 5 years. Don't try to time the market. If you have a long-term mindset, then it's best to just get in. There are many nuances to this, but for the most part, without luck, you won't be able to time the market. Be consistent. Keep investing and don't be intimidated by fear, and you'll be on your way to growing your wealth that will lead to financial independence. Well, I hope that you have a better understanding of how the stock market works and some ideas for different options that are out there for you. By putting your money to work in the market, you'll be able to set yourself up for financial independence in a matter of time. Let me know in the comments below if there are any money topics that you want me to discuss, and I'll consider making a video on it. Thank you so much for watching. Before you go, do me a huge favor share, and if you like this video, hit that thumbs up button. Also, be sure to subscribe as I have personal finance videos coming every week, and hit that notification bell. Thanks again, and I'll be sure to catch you in the next video. Peace.